The Bank of England has refrained from pumping more money into the British economy, voting today to maintain the official bank rate paid on commercial bank reserves at 0.5%. I'm joined down the line today by Alan Clarke, Economist at ScotiaBank in London, to discuss why this decision has been made and what the future holds for interest rates in the UK. Mr. Clarke, was this the result you were expecting and the right decision?
It was. Normally you would expect the Bank of England to continue with its programme of asset purchases. The latest one was announced a couple of months ago, unless something big changes, and it hasn't changed. Inflation has been a little bit on the high side of expectations. GDP growth has been revised up, and survey indicators suggest the trend will be improving from here. That's largely what the Bank of England thought. So there's not been anything really to cause the Bank of England to deviate significantly from its existing plans. So it's no surprise to me that they've left Bank of England policy rate on hold and persisted with their current programme of asset purchases that's scheduled to end in November.
You just mentioned the bank's most recent QE handout, which is completed in November. After this, do you expect more cash to be injected this year, or could the bank consider cutting rates below the current level of 0.5%?
In terms of cutting Bank of England policy rate, I don't think they will. I don't think they should. I think the benefit of that is minimal, and it may actually backfire, because I think it will hurt building societies, which is the very sector that the Bank of England is relying on to extend new loans under the Funding for Lending scheme. So I don't think it will do that. I think on quantitative easing it's a close call. There is a case to deliver more policy ease, but I don't think it's a done deal. And if this improvement we've seen in financial market sentiment and the PMI surveys in the UK over the last week continues, it will become more and more marginal. So it's very close. At the moment I think it's more likely than not, but it's only just above a 50% probability that we'll see more quantitative easing announced in November.
Yes, speaking of PMI, earlier this week mixed PMI showed improvements in manufacturing and services, but a struggling construction performance. Were these results reasons behind today's decision, and what could be done to aid the construction sector?
I think the committee would have been aware of these numbers, but I don't think the decision would have been solely determined by those. I think the committee will have been reassured that the surveys have done better and there's less urgency to consider more policy ease anytime soon. I think that the message from those surveys was quite good. The composite, or the average of the manufacturing and services sectors, is about 52.5, which is reasonably healthy. I think the previous month was overly downbeat. So it's the right side of 50, and there's every chance that it should continue to improve. So I think the committee will be reassured and be less compelled to pull the trigger on more easing imminently.
Looking at inflation, do you expect inflation to fall to target?
No, I don't. I think the pickup we've seen in petrol prices, the drought impact in the US eventually feeding through to higher food prices over here, milk price increases, banana price increases, university tuition fee hikes, you name it. It's all going to keep inflation alongside the Bank of England's 2% target.
Lastly, British GDP shrank 0.5% between April and June compared to the first quarter. How has the British economy fared under quantitative easing, and what do you see for British GDP in the future?
Well, I think that Q2 number was artificially distorted. We had a lost working day, which doesn't sound like a lot, but if most of the population works a 20-day month and you lose one day, then that's a 5% drop in output in that particular month. And it's probably contributed to about 0.5% drop in output on average during Q2. So were it not for that, GDP growth would have been zero. Furthermore, if you strip out the dodgy construction sector data, if they've been all over the place, then GDP growth in underlying terms is probably reasonably positive. So I don't think it's as gloomy as the headline numbers suggest. Will be artificially boosted in Q3 as the effects of that bank holiday are unwound and we get a boost from the Olympics. So it's really, really hard to read into the headline numbers at the moment. The trend is your friend, and I think it's steadily upwards, and it will make it less necessary to continue with quantitative easing as time progresses.
Thank you, Mr. Clarke, for joining me today. Stay tuned to Dukascopy TV for all the latest news from the European Central Bank decisions. For now, take care.